then from 14 to 1430 to 16, then 19 to 2130, like that. If you watch, you will be able to understand what they are doing in the market. Why I am telling this? During the early and the late sessions, they try to handle the majors. If you are focusing on the majors, you watch only those two part of the sessions. Each session is divided into three sub-sessions, namely early, mid and the late sessions. So during the early part of the session and the late part of the sessions, they handle the majors, and during that of the mid session, they handle the crosses. So when you note down the initial low and the high around 3:30 GMT from that of the live market quote page. So this is the live market quote page. I just given the link also. You find that the high and the low are shown, but here you come across the high as 1.2822, but initial low was different, and I will show with the help of another slide. The initial low in the case of euro was 1.2771 by 3:30 GMT, and this I have been showing it during that of the Asian session live market analysis webinars on Mondays and Thursdays. So the same slide I am using it, and here you come across in the GBP 1.5916 was the initial low, and here you come across 1.5884. That was a new low they have formed during that of the early part of the Japanese session. Then subsequently they stop cutting the low and come above that of the initial low. Initial low is 1.2771 and the current bid is 1.2775. It has come above. In the case of GBP also, it has come to that level of 1.5916, the initial low. So if you notice in the fxtrade.net the blog, I mentioned that they made a quick drop from 1.2771, breaching it, and came down to 1.2737, stopped cutting the low for 30 minutes. Then subsequently what happened? And there are questions also, you are not able to understand and things like that. Then I explained that it is an extended move. Extended move is a quick move, and intentional move is a slow move. They made a quick drop, and immediately some attributes were flashed in the websites and things like that. Later on they started gaining the level, and now they are above that of the initial low. So what has happened in that process? When the players find that the traders are predominantly long when they just made a small dip, and before making a rise they make a downward stop end. So the stop end can be for 30 minutes for about 10 to 30 pips. And if it is an extended move, they can just drop from this another 30-40 pips, sometimes even 75 pips, and reverse it in a matter of 2 hours. Stop cutting the low, new low, and come above that of the initial low. This is the criteria they do it. So now we might be able to understand that the attribute what has been given is wrong. Ultimately the players wanted to make a rise in the case of euro. This understanding is very important for us to take a trading decision. So we note down the initial lows and the highs around 3:30 GMT and find out whether euro has dropped or gained. What if it has dropped? Have they stopped cutting the new low for 30 minutes? Then you try to take a buy position. You will be able to close it near that of the low what they have set. And if you want to still maximize the profit, trail the stop in the profit making position, let them breach the high and go above, and stop cutting the new low for 30 minutes, then book profit. So this is how one should be able to take the trades whenever they are making quick moves. So it is not necessarily that we have to take a position and wait in the market. Instead we wait for a good opportunity to enter into the market and also exit out of the market. So that is a basic plan of my trading strategy. So for that we note down the initial lows and the highs. In euro, for example, 1.2771 was the initial low and 1.2822 is the initial high. Even during the European session the high is not changed, whereas the low was, previous low was different, and now it is above that of the initial low. And in the case of GBP, above that of the initial low now. 1.5918. And in the case of USD Yen, what happened? So the initial low was 91.65, 81.65, that is not breached, and the high was 81.97. They formed a new high 82.22. So in the case of yen, I have been mentioning many times that they make the one-sided move, not like Euro and GBP making either way swings. They are caught on the wrong side, that's it. You have to accept and close the position with loss. And if you think that it will make a swing, they will slowly gain and again, and you may not, the loss will multiply, and you may not be able to close the position. When the loss becomes more, then you think of doing an averaging trading, of taking further sell, and you will find that it has led to over trading. They continue to gain the levels. So we have to understand it is nearing the year end. So they are expected to make the one-sided moves in the case of denominator currencies. Keep it in mind. So don't do sell and buy trades in the case of denominator currencies. When they drop and set the new low, you can take a buy, and when they make a quick rise, book profit. Now, so what do you understand out of this in the case of USD Yen? So it has formed the new high 82.23 and holding around 82.22. So when they hold above that of the initial high 81.97 for more than 30 minutes, then they are expected to continue to rise slowly. Because the rise is slow, they wanted to make an intentional gain of slow gains in the case of USD Yen. So read it properly so that you will not commit a wrong trade. They intend to make a slow rise. Any dip is a buy opportunity. When they come closer to that of 81.97 or 82 level, we can take a buy. But aiming 10 pips profit, if we try to sell it 82.22, they may not give it. If you fail to book profit, and again it will continue to make the loss. So please understand that when Euro is gaining, why should USD Yen also gain? That is what many people ask. But I have been explaining many times, these are all called as a contrarian moves. So they just gain the levels in the case of Euro and USD Yen. As a result, you find that Euro Yen is also gaining. So in order to gain the levels in the case of the respective crosses, they try to make this sort of contrarian moves, gain in the case of Euro, gain in numerator currency, gain also in the denominator currency. As a result, their crosses continue to gain. So this is the double-edged effect they bring in the market. Then coming to that of CHF, 93.97 was the initial low, and 94.58 was the initial high. 94.32 was the initial high. They formed 94.58. A new high, and come below that 94.16 currently. So when they just formed a new high above that of the initial high and come down, and you find 17 pips positive net change in the case of CHF and 26 pips negative net change in the case of Euro. So when Euro has dropped more, CHF is not gaining more. So it is not corresponding. So they intend to hold around in this particular range. Afterwards, they are also expected to gain the levels in the case of USD CHF. So when Euro is gaining, don't think immediately we can sell USD CHF. They may just go up to that of the low or slightly lower and reverse. So better wait for the low to be set or the new low to be set and try to do a buy and sell trade in the case of USD CHF. Then with regard to Canadian dollar, 99.67 is the current level. 99.58 was the new initial low, and 99.78 was the initial high, whereas they formed a new high 99.92, and they are holding below that of 99.78, the initial high. So they wanted to swing here. When a currency is making this sort of move, don't take part in that particular currency move, because it is expected to make only a nominal swings, and it may not yield any good profit while we are holding the position. So ultimately we enter into the market identifying the tradable currency wherein you will be able to get profit, and then try to focus on those currencies. In Australian dollar, 1.037675 is the current level, and 1.0346 was the initial low. initial low was 1.0362. They formed a new low 1.0346 and reversed above 1.0362. Now currently it is 1.0375 and 1.0394 was the high, that is intact, and they are expected to breach the high and slowly gain the levels. As you see that here also they are gaining the levels. So when you note down the initial lows and the highs, then you will be in a position to understand what they are trying to do it. So let me explain with the help of the next slide. So in the live market quote page, we note down the initial lows and the highs in 4 majors and 2 commodity pairs, and also note down the net changes. The net changes are the indication from that of the previous day close, the current market situation, whether it is positive or negative, from that of the previous day US session close. So watch when the market is near the low or near the high and relax when it is in the mid level. So now you find that in between the low and the high the market stays. When it is closer to high or closer to low, then you can just watch the market. Otherwise you'll be simply holding the position, but it may not give any profit or loss, and market might stay in the same level. So instead you wait for the late session to come and commit a positions. Then why? Because the majors are active during that of the early and the late sessions of the early and late of Japanese session, early and late of European, and early and late of US sessions. The crosses are active during the mid sessions. So if you are trading in crosses, then probably you can look for their actions during the mid sessions. Now, in order to understand the market well, we need to find out what type of moves the players do it in the market. See, this is not my 1 year or 2 years of observation. It is about 20 to 22 years I have been observing it, and they have been doing exactly the same type of moves in the market. The pip variation might be seen. Earlier they used to make an extended stop and for about 100 to 150 pips. Now they do it for about 30 to 40 pips. That is the only difference. Otherwise, a quick move is a false move. They quickly drop and then slowly reverse. Their intention is they do the circular trade and drop the market. And what is circular trade? They keep a buy order and then sell it to that, and keep another lower level buy order and sell it to that. Then automatically the market comes down. Then we immediately find the 3 red candle formation. So market might go down, probably any pullback we should sell. Then when a small pullback comes, then you try to sell. Then you find that market continue to slowly gain the levels. Then you get trapped. So we think of doing the technical trade or a breakout trade and things like that. The players know very well what sort of trades the traders could do it. So in order to earn money, when the money has to earn for the money without the conversion to effort, then the cunningness play a vital role. Normally in a business, what you do is the money is converted into effort. They hire the people and hire the machinery and things like that, and then go in for a productivity, and they earn out of that solutions what they are selling to others, and then the principal comes back along with that of the profit. That is the normal way of earning money. When you deploy money in any business, money has to be converted into effort, and then effort has to be converted back into money. Whereas in the financial market, money multiplies. So they invest money and reap more money. How it is possible? Only if they act cunningly. Then they have to cheat others or just make them to understand the market differently and try to earn. So that is the only way to make money, further money. So when they have the billions and billions of dollars, the richest of the richest in the world, they deploy it through that of the private banking arms of various banks, and they just make all the swings in the market. So what they do is a stop and. During the early session and the late sessions, I explained to you, the first 1.5 hours and the last 1.5 hours of the sessions are called as the early and the late sessions. So early in the late sessions, they either go above that of the initial high, 15 to 25 pips, or go below that of the initial low for 10 to 15 to 25 pips, and reverse in a matter of 30 minutes. Whereas today they have reversed it after making about 30-35 pips drop, but after 2 hours. So that is called as the extended move. After 2 hours they reversed it. Whereas in a stop end, they just reverse in a matter of 30 minutes. Then the next type of move is a false move. What they do is, they just from the middle level go up to that of the initial high and reverse without breaching the high. Or similarly, they go up to that of the initial low and reverse. That is called as a false move. This particular false move, they do it during that of the gap time, what I have mentioned, the 3 gap times before the start of the sessions, and also during the time of the data release. So whenever there is a prime data release, they try to make a false move before the start of the data, and then subsequently reverse the market after the data, irrespective of the outcome of the data. So if you just watch, for example, 12:30 or 13:30 is going to be the data release time. Around 12:25 to 12:30, if they gain the level, you can just assure everybody that they are going to drop soon after the data release. Similarly, if they make a drop for the last 5 minutes, around 13:25 to 13:30 GMT, then you can say comfortably they want to rise the market after the outcome of the data. So we may try to explore and try to find what could be the impact in the market when a data is out. So probably volumes and volumes of information we might try to retrieve and try to read and anticipate the market to go up or come down. They can simply give one excuse and make the market reversal. So that is what happening after the false move. Then the extended move, I have given the example now. During the Japanese session, they just made the drop below that of the initial low, stopped cutting the new low for 30 minutes, and they held the market 1.5 hours further, then started reversing the market and going above that of the initial high. Initial low. So that is extended move. It prevails for about 2 hours within the session. Then they make yet another important move, namely the intentional move, which is a slow move, whereas extended move is a quick move, an intentional move is a slow move. So what they do is, they go above that of the high and stay there for 30 minutes and slowly gain the levels as the day proceeds, with a small swing during the session change, and continue to gain. Similarly, continue to drop. Every 30 minutes to 1 hour they can breach the new high, or breach the new low and go below, new low and go below. And that is intentional move. That means their intention is to drop the market if they are continuously breaching the new low, or the intention is to rise the market if they continuously breach the high. So this intentional move will stay for 2 sessions. If they start from the European session, then they will continue with that of the US session, and the next day Japanese session they will make an upward stop and start making a drop. So after yesterday's intentional move on the upside, then today they made the extended downward move for 2 hours during the Japanese session and start gaining the levels now. So what do you understand from that? They alternate the extended move with that of the intentional move on a daily basis. And when the intentional or the slow move is on the upside, understand that they quickly dropped the market, hit the stops of the long holders, the weak long holders or over-traded long holders. They have got cluster of stops in a close by area. They try to hit and also induce the traders to sell. Technically, when they quickly make a drop, immediately the traders go in for a distress trade of participate in the market, quickly sell, so that they will be able to capture some profit, because some bad news is coming from Greece and things like that. He will also sell, later on find that he got struck. Then ask everybody when Greece data was negative, so probably the outcome is not given any solution why euro is rising. He will be asking. By the time the market would have gone up and hit his stop. So we need to understand what is their intention. So that is the intentional move, which is a slow move, and if they breach the high and go above continuously, then it can remain for 2 sessions, and the start of the 3rd session they will try to reverse the market with an extended move. So today's condition, they're still holding above that of the initial high, initial low. Still they have not breached the initial high. So they have to breach the initial high and then continue to rise. So European session, late European session, they might breach, and then they may hold it for US session, and tomorrow Japanese session, and only tomorrow European session they could make next slide. So that is how the market moves are. So slow moves, when you see, don't think that market is sluggish and market is not capable of gaining levels and things like that, because they hold the market in such a way so that the traders lose the patience. Those who have got long level, long position around 1.274045 and things like that, they could quickly book profit thinking that it could reverse again, or they make a small dip of 2-3 pips and just pretend as if it is going to drop, then the traders sell. So they want the traders to do wrong trade before making further rise. So we have to ask one question: when we are all willing to sell, somebody is buying, is he a fool? And so if you ask that question, then you will be able to really understand how in a cunning manner they try to manipulate in the market. Then coming to that of the next part, namely the swings during mid-sessions. So the swings are the moves between the initial low and the initial high. They make the contrary moves, sometimes euro gaining and GBP losing, or GBP gaining and euro losing, and this sort of contrary moves in the form of swing without breaching the initial high and the initial low. And these swings, they do it during the mid-sessions, and that way they are able to handle the crosses. So after understanding the various types of moves, then we also need to understand the trading strategies, because whatever the effort we put in and try to read their intentions, and you know, the players are much more smarter than us, and they find out whether the traders are able to understand their tricks. And if they find that the traders have understood the trick and trying to participate in the market, then they try to reverse the market and try to earn from them. And you know that about 5-6 years back, when you ask any of the technical analysts, they never used to give the calls pertaining to that of the breakout trades. At that time, they used to find only the supports and the resistance, and then around that of the support, try to take a buy, around that of the resistance, exit. They try to calculate the short term and the long term supports and resistance and things like that, and also find the pivot points in order to understand, or the Fibonacci retracement, etc., and then try to give the call, buy near that low and sell near that of the high and things like that. Then subsequently they found that most of the time what they call it as a noise in the chart as the stop outs, and this stop outs just stopped them out before making further move. So if somebody would have taken a buy position, the market would have simply dropped and hit the stop and come above and gone above. So immediately the trader would think that, I think it is not wise to keep the stop, so that if they make a dip also we can hold it, and later on they gain as per our expectations and we can book profit. So that has led to the tendency of avoid keeping the stops for most of the traders. And also when they kept like that, players made big moves. If you see in 2005, 2006, 7, 8 and things like that, they made big moves of 150, 200 pips drop and again in a single day. So if a person is trading without a stop, then invariably there will be a margin call. So Then subsequently, the analyst also started giving the breakout trades as a prime type of trades. So when it goes above a specific level, then try to take a buy position and book profit. When it goes below the support, and then try to take a sell position and book profit. That sort of breakout trade strategies they are given. And what the players are now doing, they do the breakout and reverse. And in such a way, the breakout is only for about 15 to 25 pips. And if the trader is not in a position to keep stop at entry, he will be struck with a high level buy or a lower level sell. So the players also understand what sort of trading strategies the traders do and accordingly make the moves. So in order to avoid being hit by the market again and again, we can use the entry stop or the hedging instead of the stop. And so when you use the hedging, then they might hedge us and the market might go against us. When they reverse, we can stop out at the entry in the hedge and continue participating with it of the buy position when they are making the rise. So it's a simple strategy. Use the hedge, and as soon as the hedge makes profit, keep stop at entry, and when they make the next move in line with our expectation, we continue to trade, so that when they make an adverse move up against us, we need not worry. So that is a simple strategy of using the hedging instead of stop. In US platform it is not available, but European and Australian platform it is available. I'll explain more at the time of taking positions how the hedging can be effectively used for different type of trades. So how we determine the entry, this is very important. So 30 minutes from the start of the session, the European session started around 8. So 8:30 by the time we will know where to enter, or after an extended move. So they had done the extended move during that of the Japanese session. As I explained, with the help of the live market code page, they formed the new low and stopped cutting the new low for 30 minutes. We can take a buy there. Then afterwards you find they come up to that of the initial low. The initial low was 27.71, and see whether they are breaching and going above. They are not going above after coming closer to that of the initial low. In 30 minutes time, we can book profit. If they go above and stay above there for more than 30 minutes, above that of the initial low, then we wait for them to breach the high. And when they breach the high and form the new high, we wait for 30 minutes whether the new high is further breached. If they are not breaching it, we can just simply close it with the profit. So our entry is we watch any move, quick move, for 30 minutes. If it is a quick downward move, we watch for 30 minutes. If you become smarter or more experienced with this sort of understanding of the quick moves, that can be seen in the live market code page more effectively than in that of the charts. 5 minutes chart, 15 minutes chart, or 30 minutes chart. No, the chart becomes a lagging indicator, because after the event only the chart forms the candle, whereas in the live market code page, pip by pip, you can see the move whether they are breaching it or not for 30 minutes. Then immediately you can take a buy position. Still we can keep the entry stop or the hedging order to limit the risk. So at any time when you desire to enter into the market, we try to see that our risk is minimal, but still we do not want even take atom of risk, and so we try to keep the hedging order to limit the risk only to 30 pips. And we know that strategy how to come out of the hedging in case if it is hedged. Then we have a total solution in our hand. So we will be able to do the trade without being influenced by the quick moves in the market. We don't become perturbed. We try to read whether it is an intentional move or an extended move. If it is an intentional move on the lower side, say for example they continue to breach the low for more than 2 hours, then we wait simply for 2 sessions, and at the start of the 3rd session near the new low, when the low is not breached from the start of the session, we take a buy. Then they continue to reverse the market. So our entry is primarily 30 minutes from the start of the session. In the event if we observe the extended or the intentional move, we don't enter in between. We try to enter after the completion of the move. Hope you are able to understand. so that our trade will be a very safe trade, and 99.9% we will get an assured profit in that. Then how to exit, as I explained, then take profit over the next opposite level or the next opposite move, then near the high, see whether they are coming closer to high. After coming closer to high, are they breaching it or not? You just watch for 30 minutes when they come closer to high. If they are not breaching it, you simply close the position. If they breach and stay above that of the initial high for more than 30 minutes, then understand they wanted to make an intentional move. After the extended move on the downside, they wanted to make an intentional move on the upside. So intentional move will be for 2 sessions and the start of the 3rd session. So still in the European session, they are below that of the initial high. So when they breach the initial high, most likely it will be during that of the US session. So from US session, another session will be the Japanese session. The 3rd session will be the tomorrow European session. If at all you wanted to sell tomorrow, start of the European session, you try to take a sell, they'll make a drop. You will be able to quickly book profit. So we are not bullish or bearish. We only look for their type of moves and then try to participate in the market. So we don't worry whether euro is supported or US dollar is supported and things like that. We wanted to know how the players play in the market. If we know the strength and weaknesses of the players, we can just capitalize it. Then exit when the new low is not breached. We try to, new high is not breached, we try to book profit. And also, in order, as a trading strategy, once the position makes profit, keep stop at entry. And once the position makes 25 pips profit, we trail the stop in a profit making position. We use the hedging instead of stop in a loss making position, and we try to use the stop in a profit making position, and also keep a trailing limit. As I said, 1.2822 is the high. We try to keep it as 1.2827 or 3-4 pips above that, depending upon the spread between the bid and the ask. So we try to keep it. After coming to 1.2822, see whether they are breaching or not. If they breach, then move your limit upward. And if they don't breach, just modify and close it around that of the high. So this way we can just move the limit and also move that of the trailing stop. So market can either hit your trailing stop or your limit, but still profit is protected. Coming to that of the trading, what do we intend to do it? Now we will watch it in the live market quote page, what trade we can do. Now, as I explained, they have come above that of the initial low in the case of euro. So we will try to keep a limit order. That will be about 5 to 10 pips below that of the current level. Why? Because they have breached the initial low and gone above and still holding above there. But market means swings. They have to make small swings here in order to keep the market alive. So we just try to participate in the market whenever they are making a small dip. So earlier days I used to recommend about 10 pips, because nowadays they are not making such big moves. They are only making 5 pips move. So we will try to keep 1.2783. So we will keep a buy limit 1.2783 and an entry stop or stop. We can use it 30 pips below 1.2753. So even though market is in the middle level, it has breached the initial high 1.2771, and so because we are late entry into the market, because I was spending more time in explaining it. So otherwise 8:30 GMT we could have taken easily near that of the initial low, the buy position, but doesn't matter. We know that they intend to make a rise, so we will try to book profit. And if the order is filled, fine. We will watch for about 30 minutes. If the order is not filled, we modify and take the position in the market. We always wait for the swings to fill our order. In the event if it is not filled in 30 minutes of observation, then we try to modify the order, so that there is no urgency in taking positions, and we don't think that the market will just miss us and go above. We know very well market will continue to give trading opportunity. Similarly in the case of GBP, .5921 is the current level, just 5 pips below. 1.5916 we will keep a buy limit order and a entry stop. Okay. Just two currencies, I am just showing it as an example, and we will just keep the order. They are only limit orders. We will try to find out what happens, whether they fill it or not. Otherwise I will try to modify and take the position and try to close the position within the session or during the next session. I will try to explain to you the fate of this particular trade, these two trades, during the second part of the webinar. So ultimately, if you understand well how exactly we decide on the entry, how exactly we decide on the exit, based on the type of moves and also based on the time frame of the market, early and the late sessions. Now I am taking the position during the mid session. That is not right. Actually, in the early session I would have taken the position at a much lower level, then you would have booked profit. In the event, what I do is I try to show it as an example by taking the position during the mid session. So even in mid session you can participate. If you are well versed with the market, you can participate and try to enter the market. They are making a small dip now, so you might see that our order also get filled. Then see, anyhow we have the hedging order to limit the risk. We are not taking unlimited risk. So if you just plan beforehand taking positions, now they are giving it 27.83. It is now, it becomes buy position. Similarly 59.16, it becomes a buy position now. So we have the buy position in both. Let us see what happens to those positions. Okay, slowly, and understand how we are trying to exploit the weakness and the limitations of the players in order to earn money from the market. So if you have got any questions, you can just put it in the chat window. I will try to answer to those questions. I will come back by 15 GMT and give the second part of the webinar, Tracking the Forex Market Together, Part 2 webinar. I will commence by 15 GMT. Meanwhile, the two positions what I have taken, I will try to show you what happened. If it is hedged, how I handle the hedging. If it is not hedged, how I kept stop at entry and trail it and move the limit away. And by 14 GMT, I will try to close it. In case the intentional move is very apparent, that it is not a swing up to that of the high. If they are going above that of the high and staying there for more than 30 minutes during late European session, I will continue to hold the position till US session and maximize the profit. Hope you are able to understand. Based on the type of move only I am trying to do it, not on sentiments. Okay, so I will come back by 15 GMT And also we'll just find out what happened to the initial low and the initial high, whether they formed a new low, new high and things like that. And also review the trades what I have done, and also I'll try to commit new trades for the European session, US session, and show you how exactly the trading decisions can be taken very easily using the live market report page. So thank you one and all. I'll come back by 15 GMT. Please come back and attend the second part of the webinar. You will be able to understand the continuity of this particular webinar. Thank you one and all. Thank you FX Street. We'll see you again by 15 GMT.